background.
Similar to financial options, real options give the technology owner the right without any obligation to pursue a specific alternative. This real options approach partitions firm or investment value into two components: the value of discounted cash flows from the firm's existing activities and the value of options that the firm holds. 1. Where CT denotes the value of discounted cash flows from ongoing operations and OI denotes the value of the firm's options. Simply put, options provide opportunities for discretionary investment, and thus, confer choice. This is a non-trivial issue with regard to a firm's strategizing, since much of a firm's strategy is emergent. Managers cannot remain static on formulated strategies but must continually refine these in response to changing environmental conditions as well as opportunities provided by a firm's internal operations. 2. Environmental jolts may occur without warning and may make current resource utilizations obsolete. Firms hoping to withstand these jolts must have a repository of potential responses, or face the threat of failure. One should also note that changes in environmental conditions may create opportunities for prepared firms to enhance competitive positions as well. Firms that possess wide arrays of valuable responses to environmental change have the greatest opportunity to gain in turbulent environments, and thus have greater propensity to develop or maintain competitive advantages. This flexibility of response makes simple possession of an option valuable. Firms that possess more discretionary alternatives will perform better in times of increased environmental volatility than will less prepared competitors. 3. The real options develop some stylized categories of real options, most notably the following. Growth, platform or learning options refer to opportunities to expand operations or enter new markets based on experience in utilizing a resource. 4. For example, understanding therapeutic uses for a drug compound after intense research scrutiny may provide the owner with many options that were unanticipated or unrecognized at the beginning of experimentation. In some cases, newly discovered uses prove more valuable than the originally identified implementation. For example, Pfizer's Viagra, which was initially targeted to treat types of arrhythmia until researchers identified efficacy in a much more profitable impotence market. It is important to note that experience often provides the platform for further exploration and knowledge acquisition. 4. Apple's knowledge developed through its experience failing with Newton handheld computer devices appears to be instrumental in its subsequent successful introduction of iPod, iPhone, and iPad products. Deferral options reflect abilities to delay decisions on investments without prohibitive cost. An example of a deferral option is the ability to delay commercialization of a product until greater understanding of consumer market conditions are gained. Abandonment options provide the owner with the ability to terminate pursuit of an activity. The shuttering of a plant that no longer produces with efficiencies desired by management is one example. Switching options provide the ability to alter the inputs or outcomes of an investment path with minimal cost, for example, change inputs, move to new output market, etc. Soft drink manufacturers exercised their option to switch sweeteners when they replaced pure cane sugar with the cheaper high-fructose corn syrup. Generally, real options theorizing attempts to provide guidance on managing the effects uncertainty and irreversibility, with some assumption of decision-maker rationality, have on investment value. 6. We will use the commonly employed oil field example to demonstrate. 7. Assume that during periods of wide fluctuations in oil prices, but with no clear trend, a firm considers adding an oil field to its investment portfolio. Outright purchase of the oil field entails considerable upside potential given the possible rise in oil prices. Purchase, however, also entails considerable downside risk since oil prices may also decline. Holding an option, that is, the right without obligation, to purchase the oil field alters the returns distribution in comparison to the opportunity to merely purchase the field. The option to purchase provides the option holder with the ability to defer decision until he can collect more information about price trends, that is, reduce uncertainty. If the owner notes a clear upward trend in price, he may choose to exercise the option by buying the oil field at the price specified in the option contract, thereby benefiting from the option's upside. He may also own the right to sell the now more valuable option to another party. However, if oil prices appear to be decreasing to the point where investment is unprofitable, the firm can simply choose not to exercise the option to purchase the field, thereby limiting its downside. Therefore, one witnesses an asymmetric return pattern from option possession where upside potential is limited, among other things, by the maximum value of the underlying asset, for example, the oil field in this case, whereas a downside floor is limited to opportunity costs of option possession, assuming that the firm acts rationally and does not pursue value-decreasing options.